Your P&L says you're making money. Your accountant confirms it. When you look at the top line, the bottom line, it all checks out. The business is profitable. At least that's what the numbers say. But then you open your bank account and it doesn't feel like a profitable business. Payroll feels tight. You're watching the balance more than you used to. Maybe you're leaning on a credit line you thought you wouldn't need. There's a tension between what the financials tell you and what your gut tells you. And that tension is real. So you ask the obvious question: if we're profitable, where is the money? And I want to be honest with you. That question is more common than most owners want to admit. It's not a dumb question. It's not a sign you don't understand finance. It's actually one of the most important questions you can ask about your business. And the answer is almost never what people expect. Here's the thing nobody explains clearly enough: profit and cash are not the same thing. They're related, they come from the same business, but they move on completely different timelines, and they respond to completely different forces inside your operation. Profit is an accounting concept. It's revenue minus expenses, following specific recognition rules. Cash is physical. Cash is what's in the bank, and the distance between those two things is where most of the confusion lives. Let me walk you through something I've seen more than once. A company is growing, revenue is up year over year, margins are holding, the P&L looks clean. Ownership is feeling good, the team is executing. By every normal financial measure, this business is doing well. And on paper, it is. But underneath that, cash is quietly tightening. Not dramatically, not a crisis, just a slow squeeze. A little harder to cover payroll this month than last month. A little more mental math about what's clearing and when. A little more reliance on timing, hoping a deposit lands before a payment goes out. And the worst part is, nobody can point to the moment it all started. The first instinct is to usually look at revenue. Maybe we need more sales. Maybe we need to push harder this quarter. But revenue isn't the problem. The P&L already told you that. The problem is what's happening between earning the money and actually having it in the bank. And that's a completely different conversation. That gap has a name. It's called working capital. And it's the single most common reason profitable businesses feel broke. Working capital is the money tied up in running the business day to day, what your customers owe you, what you owe vendors, and what's sitting in inventory or work in progress. It's not a line item on your P&L. It's not something your accountant highlights on a call, but it's the plumbing of your cash flow. And when it shifts, you feel it before you can explain it. There are three places where cash gets trapped: receivables, which is money your customers owe you that you've already earned; payables, the money you owe your vendors that you haven't paid; and inventory or work in progress, which is money you've spent that hasn't converted to revenue quite yet. These three things make up your working capital cycle. When any of them shift, even slightly, your cash position moves with it, even if profit doesn't change at all. In the situation I'm describing, receivables had crept from about 45 to 78 days. That didn't happen overnight. It happened slowly, one extended invoice at a time. Maybe a big customer asked for net 60 instead of net 30 terms. A couple invoices went 15 days overdue and nobody chased them. Another client started paying in two installments instead of one. No single event was alarming, but the cumulative effect was real. The business was quietly funding its customers, letting them hold cash longer while still covering its own expenses on time. And here's what most people miss: growth made it worse. Every new dollar of revenue added more receivables, which meant more cash stuck in the pipeline for longer. The faster they grow, the wider the gap between profit on paper and money in the bank. This is one of those counterintuitive things about business that nobody warns you about. Growth consumes cash, even healthy, profitable growth, especially when collection cycles are stretching at the same time. And receivables weren't the only leak. Inventory was quietly piling up too. They were ordering ahead to support growth, stocking up, buying in bulk to get better pricing, building a buffer. Reasonable decisions individually, but collectively, inventory had grown faster than sales for 3 straight quarters. That's cash just sitting on the shelves. Cash that's already been spent but hasn't generated a dollar of revenue yet. And unlike receivables, nobody was tracking inventory turns as a financial metric. It was just product on hand. So the business didn't have a profit problem, it had a timing problem. Cash was earned, just not collected fast enough and not managed tightly enough to keep up with the obligations. That's a working capital problem. It's fixable, but only once you see it for what it is. And that's the key point. Most owners don't have bad businesses, they have invisible cash dynamics that nobody is surfacing for them. So here's how you check whether this is happening in your business. 3 things. None of them require a finance degree. None of them require expensive software. You can do all 3 with the information you already have. First, track your days sales outstanding, DSO. That's the average number of days it takes your customers to pay you after you have invoiced them. Here's how you calculate it. Take your total accounts receivable balance right now and divide it by your average daily revenue. Your revenue divided by 365. The number you get is your DSO. If that number is trending up, even by a few days per quarter, you're funding your customers whether you realize it or not. Don't obsess over the exact number, watch the trend. A DSO of 45 isn't inherently bad. A DSO that was 45 6 months ago and is now 62, that's a problem forming. Second, look at what's sitting. Inventory, work in progress, deposits you've paid to vendors, anything you've spent money on that hasn't turned into recognized revenue yet. If that pile is growing faster than your sales are growing, cash is getting trapped in the operation. This is especially common in product businesses, project-based companies, and seasonal businesses that stock ahead of demand. The question to ask is simple. Is the value of what's sitting on my shelves or in my pipeline growing faster than my top line? If yes, that's where some of your cash went. Third, compare your net income to your cash flow from operations. You can find both on a standard financial statement set. If your profit is consistently higher than your operating cash flow, month after month, quarter after quarter, then something in your working capital is absorbing the difference. That gap between profit and operating cash flow is the answer to the question, where did the money go? You don't need to understand the full cash flow statement, just compare those 2 numbers and watch the spread. If profit keeps winning that comparison, working capital is the culprit. The fix is not complicated. It's operational discipline. Tighten your payment terms where you can. If you're at net 45, explore whether net 30 is realistic. Get invoices out the day the work is delivered, not a week later. Follow up on collections before they're late, not after. Look at what's sitting in inventory or WIP and ask honestly whether it needs to be there or whether you're buying just for comfort. And start watching the gap between profit and cash every single month. Not because something is wrong today, but because this is how you stop it from becoming wrong 6 months from now. In the business I described, the turnaround wasn't dramatic. They shortened payment terms on new contracts from net 60 to net 30. They implemented a simple weekly collections review, which is just 15 minutes every Monday. They stopped pre-ordering inventory more than 45 days ahead of time. Within 2 quarters, DSO dropped from 78 back to 52. Cash on hand increased meaningfully, even though revenue and profit didn't change at all. Same business, same P&L, completely different experience of running it. At the end of the day, profit tells you what you earned. Cash tells you what you can actually do with it. If those 2 things aren't moving together, it doesn't mean your business is broken. It means something operational is absorbing the difference. And once you see it, you can manage it. That's the shift, from reactive to informed. That gap between what you've earned and what's available, that's where the real story of your business lives, not on the P&L, not in your revenue, in the timing, the process, and the discipline underneath the numbers. If you've ever looked at a profitable month and still felt tight, now you know why. and now you know where to look. Next time, I want to talk about what happens when the thing that's supposed to save your business, growth, is actually the thing that's making it harder to run. We touched on it a bit today. Growth consumes cash in this example, but that's just one way growth creates problems. It also breaks systems, overwhelms teams, and exposes every process gap you've been getting away with. I'll see you in the next one.